Welcome to Trading Nation, folks. I'm Eric Chemi. Today, let's take a look at consumer discretionary. It's been surging this year, the second best performing S&P sector. But our next guest says it's time to get cautious on the space. Let's bring in the Trading Nation team. Matt Maley is with Miller Tabak, and Mark Tepper is with Strategic Wealth Partners. Mark, you're shifting to underweight consumer discretionary. You got to tell us why.
Yeah, so I mean, we're doing that given where we're at economically right now. We just feel like at this stage of the cycle, with the Fed committed to raising interest rates over the next 2 years, we've got to lighten up and sell high. So, in addition to interest rate hikes, the Fed's doubling down on tightening by unwinding their balance sheet too. And right now we've got both household debt ratio and household debt service payments, which have bottomed and are now actually on the rise. And, there's no doubt that the consumer has been on fire. I mean, personal consumption grew like 4% in real terms last quarter. However, that pace just can't be sustained unless we start to experience consistent wage inflation, which we're not seeing. You throw in a personal savings rate of somewhere around 0, and it becomes pretty obvious that a lot of the consumption that we've seen has been financed through credit. Revolving credit is soaring. And when you look at the small commercial banks, delinquency and charge-offs are actually at recession-type levels right now. So, we feel like that tailwind is winding down. And at this point, even a modest tick down in consumer confidence coupled with rebuilding up that savings can really dent consumer spending. So we're avoiding stocks like HarleyDavidson and Tiffany. And those have products that
Those are pretty different from each other. Harley-Davidson and Tiffany are as far away on the spectrum to me, it seems.
They are, right? I mean, one's rugged and one's beautiful, right? So, but they represent products that aren't a necessity, right? People still need to drive their Ford back and forth to work, but having a Harley isn't a must. So stocks like those are going to be negatively impacted. And same thing with Tiffany. I mean, consumers are making more economical buying decisions today, and high-end jewelry isn't economical. So, the consumer is far from dead, but we see enough warning signs out there on the horizon that have caused us to just scale back, given the fact that we're in the 7th or 8th inning of this bull market.
Okay, Matt, let's turn to you. You heard everything that Mark had to say. What are your thoughts here? What are the charts telling you?
Well, kind of the same thing. It's kind of weird. We're actually seeing a nice move, or a fairly positive move, in the XLY, which is the consumer discretionary ETF. It's made this kind of what you call a symmetrical triangle formation, and it's broken above the top end of that. However, two things. Number one, a lot of that has to do with Amazon because they're the highest weighting in the sector, and you really want to see that make a higher high above the January highs before you really confirm that the all clear sign is taking place for that group. And it's interesting that Mark talks about what do you really need to have? Do you really need Tiffany's? Do you really need Harley-Davidson? And one of the stocks I'm looking at on a technical basis is Starbucks. The Starbucks now, it's not just because of consumer demand, but the stock has been stuck.
That's a big difference, though, Matt, right? That's very different from Harley and Tiffany in terms of people would say they need their Starbucks multiple times a day, right?
Well, but you say, do you need your Starbucks or do you switch to Dunkin' Donuts, which is considerably cheaper?
Oh, that's two different groups of people, though, Matt. I don't think those people cross over. I know we got to get the chart back up, but it feels to me like Dunkin' people and Starbucks people, I don't know how much they cross over to the other side.
Well, we'll see what happens if indeed you start to see the consumer, as Mark talked about, with consumer debt piling up. Where can you pull back? I mean, it's a considerable difference. And you talk to people on an individual basis. I say, I can't believe I pay this kind of money for my Starbucks coffee. At some point, what are they going to get rid of? Are they going to get rid of their phone? Or are they going to get rid of other things? I think Starbucks could be one of those things. And the key is the stock has been stuck in this range for quite some time. On a technical basis, it made a double top here in 2015 and 2017. So if it breaks below that end of that range, it would confirm a double tops in place and would be quite negative for the stock. So that's one I'm going to be watching, even if the Starbucks guys stick to their coffee.
So XLY, this could be a jump ball for either of you guys. We're around 106 right now on the price level there. What's a good target price on a short trade here, and maybe what would be a good stop out if things go back up?
Personally, I mean, I do think consumer discretionary is still going to move in a positive direction. I just think it's going to underperform the S&P 500. So if we look out a year, we're at 106, maybe it gets to around 110. I mean, at some point it's going to start to peter out because we're going to see that the consumer begins to get crunched a little bit. So don't mistake what I said for believing that the consumer's dead and that consumer discretionary is going negative right out of the gates. It's just going to slow, right? And it's going to underperform the S&P 500.
So then would you actually do a spread trade rather than an outright short XLY?
I think that might make a lot of sense. I mean, that gives you some protection and certainly gives you the ability to protect the downside.
Okay. Mark, Matt.
And you also have to...
Oh, go ahead, Mark. Yeah, go ahead, Mark.
No, obviously the one that we all want to know about is Amazon, too. It's been an unbelievable stock. Sometimes, you know, a good stock doesn't necessarily, I mean, a good company is not always a good stock. Well, Amazon's been both a great stock and a great company and a great stock for quite some time. But, you know, you look at two of the smartest people in the world, or the investors in the world, Warren Buffett. He loves Jeff Bezos. He loves the company, but he's not buying the stock. Why? Because it's way too expensive for him. You're trading over 300 times for earnings. And you got Sam Zell, who, you know, he's talking about if you're buying Amazon here, you expect that you're basically betting that Amazon will be 25% of the U.S. economy in 10 years. That's almost impossible, basically virtually impossible. So Amazon's a great company. It's a stock that I don't necessarily, you know, people don't necessarily want to sell it here, but I would, or certainly not short it here. But buying it here could be a problem. And if we see another dip in the market, it's going to be a source of cash, and so that could lead to some underperformance in this group on the downside as well. So keep an eye on obviously Amazon. It's the most important stock in the area, but it is very, very expensive. As good as a company as it is.
Good stuff. We got to come back in 10 years if it turns out Amazon is 25% of the economy.
Yes,
we'll be like, oh, look, Matt Maley said that was not going to happen, so we'll be able to play this video in the future.
And I'll be dead wrong.
Mark and Matt, thanks for joining us here on Trading Nation. My thanks to both of you. And for those of you watching today, we appreciate it. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.